Good evening. My name is Amber Robinson, and today I'm going to be discussing the Bernie Madoff Ponzi scheme, the largest fraud financially in history. It truly was a fraud of mass proportions, and I hope that you will enjoy this presentation. For my executive summary, I will go over the following: Bernie Madoff's short bio and humble beginnings, his career and behavior, fraud committed by Madoff over the years, how he was able to get away with the fraud, and the victims of the fraud. I'll also go over the final fraud committed by Bernie Madoff, how he got caught finally, and the consequences that immediately ensued thereafter. On a more grim note, I'll also expound upon who his co-conspirators were and the unfortunate suicides of some of the victims of his fraud. I'll also be talking about the organizations that were financially responsible and their negligence with respects to the fraud. And lastly, I'll go over the aftermath of Madoff's Ponzi scheme and a brief summary. Bernie Madoff was born on April 29, 1938 in the suburb of Queens, New York, to Jewish immigrants Sylvia and Ralph Madoff. His father was a plumber and a stockbroker and also had several odd-and-end jobs. As a result of financial strain from several failed business attempts by his mother had to work so that she can attempt to bridge the financial gap that their family was in. That left an indelible mark on Bernie Madoff, as the sting of poverty equated to failure in his eyes. It would be the very thing that chided him to chase success. The unapologetic sting of poverty would change him in ways unknown, as at that time he was a very affable young man. He would go on to become a lifeguard and sell lawn sprinkler equipment. He met his wife Ruth Alpern when they were budding teens at a basement party. They became sweethearts and eventually would go on to get married. Ruth came from a very affluent family, as her father Sam Alpern had his own accounting firm. As a man, Bernie had to figure out a way to make a name for himself to win the approval of his father-in-law, as failing in life was not an option. Ruth graduated from Queens College with her degree in psychology. However, accounting was in her blood, so she would later assist Bernie with keeping the books for his burgeoning career. Bernie graduated from Hofstra College and went on to law school. Realizing that law was not for him, Madoff dropped out of law school to set his sights on something bigger. Bernie lived in the shadow of failure from his father's failed business ventures and decided to use a desk in the corner of his father-in-law's accounting firm. $5,000 of his own money saved, and he registered his business, Bernard L. Madoff Investment Securities, BLMIS, in 1960. Madoff was well on his way as he found a golden opportunity to earn a living from. He sold penny stocks and stocks that were not really known, not large cap stocks, but smaller companies. He also sold widely speculated companies and eventually became stocks for widely speculated companies and eventually became a market maker for small companies. A market maker is a person who purchases stock, warehouses the stock, or works with individuals or other brokers to sell the stock to buyers. The way Madoff got paid was from adding cents on the already purchased stock. However, during that time, it was hard to verify the price of the stock, so Madoff could have easily bought the stock at a lower price and sold it for a higher price plus the fees. The whole process to sell the stock took about 3 to 4 weeks, as everything was done over the phone with pink sheets. This is why he was called a market maker. Eventually, he gained a reputation as a savvy market participant by embracing emerging technologies and employing innovative strategies to gain an edge over more traditional firms. As electronic trading started to gain traction, Madoff was among the first to realize its potential. By the 1970s and 1980s, his firm had become one of the largest independent trading operations in the U.S., credited with helping to modernize Wall Street's infrastructure. As this occurred, it only took Madoff 2 to 3 days to be able to complete a full trade, whereas, like I mentioned before, it took about 3 to 4 weeks. So he could trade for a shorter period of time and for higher volume. So Madoff's firm played a pioneering role in the computerization of stock and trading. He invested heavily in proprietary technology and his firm automated systems allow for efficient, high volume trading and market making. Like I mentioned before, making Madoff a respected figure in financial circles. This was instrumental in developing the NASDAQ stock exchange, and Madoff found himself holding many influential roles within the financial industry's regulatory and advisory framework. He was a founding member of the NASDAQ stock exchange and served as its non-executive chairman for 3 one-year terms during the early 1990s. Madoff played a significant role in advancing electronic trading and helped shape the market structure reforms through his involvement with the National Association of Security Dealers, the self-regulatory organization that later became part of FINRA. Also, his firm's use of advanced computer systems made it a model for market efficiency, and Madoff was seen as a thorough leader in promoting fair and orderly trading practices. His position within the NASD gave him access to a powerful regulatory circle, enhancing his reputation as a trusted figure in finance. Now, Madoff also served on various advisory committees and boards, including those tied to Securities and Exchange Commission, and financially, he was there. He also helped out financial industry think tanks. These roles further bolstered his credibility and allowed him to build close relationships with regulators and other industry leaders. Ironically, his advisory positions, combined with the prestige of his firm, helped shield him from the scrutiny for years, as few questioned the legitimacy of his operations. Madoff's proximity to regulators gave many investors a false sense of security that allowed his fraud a prolonged life. Before we go on to the next slide, I just kind of want to talk about his behavior as well. So, overall, Bernie Madoff was a very generous man. He actually paid for honeymoons of the employees. He took them out on outings to his home in Montauk with their families, paid for everything. He even paid for a woman's open heart surgery that worked for him. The atmosphere that he created was that of a warm and friendly family environment, with his sons working at his legitimate company and his brother Peter working as the compliance manager. Bernie Madoff was well known and disciplined, detail-oriented, and intensely private with his personal business. Now, former employees describe him as calm, professional, and highly controlled in demeanor. He ran his firm with a quiet authority, with control, favoring stability and loyalty over flashiness or attention. Bernie Madoff maintained a structured environment where employees were expected to follow routines precisely, and he rarely raised his voice or acted aggressively. He was polite and even charismatic in his interactions, cultivating an image of integrity and success, which made him deeply trusted by both the staff and his clients. Madoff did have a bully inside of him, in which occasionally he would take it out on his brother and berate him harshly in front of others. He was also considered a control freak. However, his leadership style also fostered an atmosphere of secrecy as well as compartmentalization. The legitimate market-making operation was separated from his fraudulent business, and most employees had no idea that the Ponzi scheme ever existed. He delegated specific roles to his high-paid personnel, and this personnel lacked the educational credentials but kept the inner workings of the fake investment arm confined to a small, trusted group, which his family was unaware of his illegal activities. To many, Madoff appeared as a generous boss, offering stable employment and even philanthropy, but in hindsight, his quiet control and selective transparency were key to concealing decades of deception. So Bernie Madoff's industry impact, and based off of his reputation and his contributions to the financial markets, he pretty much helped shape the structure of security markets, providing a model of trust and professionalism. He was a well-respected figure in regulatory innovation, as well as an early adopter of electronics and trading, chairman roles at the NASDAQ, as well as influence trading committee regulation departments. Now, let's get into the fraud. So, in the early stages of Bernie Madoff's career, he operated an investment advisory firm that was not registered with the Security and Exchange Commission, which allowed him to avoid oversight that might have uncovered irregularities early on. He promised clients unusual high returns and consistent returns, reportedly up to 18%, and structured his fees to be earned on assets under management rather than through commissions, which gave the appearance of aligning his interests with those of his investors. This non-traditional setup, combined with the opacity of his operations, laid the foundation for what would eventually become the largest Ponzi scheme in history. By bypassing regulatory registration, Madoff eventually evaded scrutiny and created an aura of exclusivity and insider success that drew in wealthy investors and institutions. A key component of Madoff's early financial web involved unregulated feeder funds, one of which was associated with his father-in-law Saul Alpern. These feeder funds funneled money into Madoff's advisory business and helped grow his investor base, often without these investors realizing the full risk or lack of oversight involved. The stock market dropped of May 1962, which shook investors' confidence and caused panic selling, created an environment in which Madoff promised a stable, positive returns, and also became even more attractive. Rather than discouraging investors, the downturn enhanced Madoff's appeal as someone who could supposedly deliver gains when the market could not. Madoff did not have the $30,000 that the investors wanted from their panic selling. He in turn borrowed the funds from his father-in-law, paid it back to the clients, and lied to the clients that he was successful in the investment venture, as opposed to telling them the real truth that he never really invested their money to begin with. These early dynamics, unregistered operations, an unregistered mutual fund that Saul Alpern was willing and dealing in and giving the money to Bernie Madoff as feeder fund arrangements and market uncertainty, they truly set the stage for the decade-long deception that followed. Saul Alpern soon retired and sold his accounting firm to two accountants that worked for him named Frank Avellino and Michael Bienes. They sought out investors from corporations, families, offices, individual bank trust departments, and they did the same thing that Saul Alpern did, but they took a fee for raising the money. They also didn't register their investment management business, and they didn't tell their clients how the money was being invested, as everything was shrouded in secrecy. Hence, Avellino and Bienes were also a substantial feeder fund for Bernie Madoff. So let's talk about Black Monday on October 19, 1987. It was a massive global stock market crash that caused the Dow Jones Industrial Average to fall by 22.6% in a single day. That was considered at the time the worst one-day percentage drop in U.S. history. For most investors, it was also a day of panic and a huge financial loss, but for Bernie Madoff, the crash served a very different meaning for him, and in some ways advantageous. It was a purpose within his long-running Ponzi scheme. So Madoff investors reported little or no losses during the crash, which made his return seem almost miraculous. While nearly every other portfolio plummeted, Madoff's appeared stable and profitable. This gave him an enormous credibility boost. People believed that he had developed a strategy such as his so-called split strike conversion technique that could deliver steady market-beating results even during times of extreme volatility. But in reality, those returns were fabricated. Madoff used funds from his new investors, paid off earlier ones, which is a classic Ponzi scheme. He also had some foundational investors who were heavy hitters in the financial circles, which helped him during this time of Black Monday. So the chaos of Black Monday caused many investors to look for safer, more consistent alternatives to the traditional markets. Madoff's seemingly ability to beat Black Monday without losses made his fund appear like a safe haven. This reputation drew in even more money, particularly through feeder funds from Avellino and Bienes, Jeffrey Pickauer, who told their clients that Madoff was their secret to success. In hindsight, Black Monday didn't just fail to expose Madoff, it really did help him grow his fraud by reinforcing the illusion that he was a financial genius. There was a request to sell the securities and get their money back. And what Madoff essentially did was that he borrowed money from his investment advisory firm, which was a Ponzi scheme, so that he can pay off these investors. So it looked like he was successful. So let's go back to Avellino and Bienes. They never put anything in writing. So one of their subcontractors puts a brochure in writing highlighting the riskless trading, which caught the attention of the SEC. So this prompts an investigation of Avellino and Bienes, finding out that they raised $444 million, and they said that all of the investing was done by Bernie Madoff, which at that time he had invested none of his money, and he was building upon a very lavish lifestyle. They were fake trades in 1992. He had one of his employees, Frank DePascali, create fake trading documents. Frank DePascali even hacked into a securities brokerage firm in the same building that they were housed in and created the fake trading documents based off of historical data. DePascali created the fake paper trail that fooled the SEC, and they closed the case. The SEC forced the accountants to give up their business and told them to return the money to the individuals. Avellino and Bienes turned to Bernie Madoff, who didn't have the money at the time. And again, Bernie had used the investments to fund his lavish lifestyle, so Bernie turns to his foundational investors once again, who came up with the money, and Bernie was able to write checks for those clients. These clients, after Avellino and Bienes closed their business, went to Madoff to have him invest their money, but the SEC gave the green light that this was okay. Still, Bernie's investment advisory firm wasn't registered by the SEC. Bernie realizes that he has to scale up his Ponzi scheme to make sure that this does not occur again. So at some point, I believe in the 1980s, he moves into the Lipstick Building before 1992 and decided to create space between his legitimate offerings on the 19th floor and his investment advisory firm on the 17th floor. Again, he never let his family or employees on the 19th floor, the legitimate business, know what the employees on the 17th floor were doing, which was the illegitimate business. Bernie soon turns to his promising investors, and he talks about hedge fund investments with high rates of return and no commissions being taken, which lured in a substantial amount of investors from other organizations. Jeffrey Pickauer was a wealthy accountant, lawyer, and investor who made his fortune through pharmaceuticals, healthcare, and finance. He actually managed the Pickauer Foundation and was a prominent philanthropist. He gave away hundreds of millions to medical and educational causes. Pickauer was one of the foundational investors in Bernie Madoff's Ponzi schemes. Though not widely known to the public, he was deeply connected in heavy-hitter financial circles, like mentioned before. Later, he was revealed to be the largest beneficiary of Bernie Madoff's Ponzi scheme. At some point, reportedly withdrawing over $7 billion in profits and extorting Bernie Madoff. What made Pickauer's involvement especially suspicious was the timing and scale of gains and losses reflected in his Madoff accounting statements. Internal documents and court filings suggested that Madoff and his staff backdated trades and further falsified account activity to show losses and gains dependent on Pickauer's needs, particularly to generate losses that could offset Pickauer's tax liabilities. So, for example, if Pickauer needed a loss for a particular year to reduce his tax burden, Madoff would manufacture losing trades retroactively on Picower's accounts. Since the trades were already fictional, Madoff could customize them at will. These fabricated losses appear legitimate on paper and then could be used by Picower to claim tax deductions, essentially turning the fraudulent operation into a tax strategy tool for his benefit. Now, while Aaron Ardvitland, a reporter of Barron's magazine, wrote about Bernie Madoff not reporting any losses, she thus raised a red flag. It really didn't get any traction. It really wouldn't be until Harry Markopolos would question the legitimacy of Bernie Madoff's tactics, as Harry was a hedge fund manager at the time who was in direct competition with Bernie Madoff for business. So, who is Harry Markopolos? He was a financial analyst and forensic accountant, and he became one of the earliest and most persistent whistleblowers against Bernie Madoff. While working at a rival investment firm in the late 90s, Marco Polo, well, they say his name Marco Polis, but Marco Polis, was asked to replicate Madoff's supposedly market neutral strategy that came consistent with high returns regardless of market conditions. After doing the math, he quickly realized that the returns were statistically impossible. So over time, he compiled compelling evidence, ultimately compiling a detailed report with around 30 red flags, outlining why Madoff's operation was likely a Ponzi scheme. Among these points were the impossibility of his consistent gains, lack of a reputable third-party custodian, which unusually steady returns that defied market conditions, and trading volumes that didn't match reported positions. Marco Polis submitted his findings to the Security and Exchange Commission multiple times between 2000 and 2008. His most well-known report, titled "The World's Largest Hedge Fund is a Fraud," was sent in 2005 and laid out a comprehensive case against Madoff. However, instead of launching a serious investigation because of Madoff's reputation, the SEC largely dismissed his warnings. In one crucial instance, the SEC sent two inexperienced examiners fresh out of college to interview Madoff. Lacking deep financial expertise and without aggressive forensic procedures, the examiners took Madoff at his word. He charmed them and reassured them, giving them vague but confident answers, and they left without uncovering the fraud, failing to even request crucial trade records or verify his operations through third parties. This failure by the SEC became one of the most glaring regulatory oversights in U.S. financial history. Despite Marco Polis repeatedly sounding the alarm for nearly a decade, Madoff's fraud continued unchecked, and it collapsed under its own weight in December of 2008. So, how did he get away with it? Again, Madoff was able to have his employees on the 17th floor create false documents and account summaries that mimic genuine trading activity. These forgeries closely resemble actual market data and investment fund reports, making the operations appear authentic and difficult to scrutinize. He exploited the trust that he had already built in the industry and with his reputation. By leveraging his long-standing credibility on Wall Street, highlighted by his former role as a NASDAQ chairman, Madoff fostered an image of exclusivity and dependability. This allowed him to attract affluent clients and institutional investors, many of whom hesitated to question the unusually consistent returns. Also, with regulatory oversight lapses. Despite receiving multiple alerts and complaints over the years, the SEC failed to detect the fraud. Contributing factors included limited resources, poor internal communication, overconfidence in self-regulation, and gaps in staff and expertise. He also maintained strict internal controls and compartmentalized information, ensuring that few employees had a complete understanding of the business. He also developed a fictitious computer trading system to mislead auditors and regulators if inspections occurred. And again, he took advantage of the regulatory gaps as well as conflicting interests and financial incentives. Some financial intermediaries and feeder funds motivated by lucrative fees and continued access to made up returns may have overlooked red flags and failed to conduct thorough vetting. All right, so on December 10th, 2008, amid the chaos of the global financial crisis, as it intensified, a growing number of investors again requested redemptions, reportedly around $7 billion, far more than Madoff had available in fresh investor inflows. This surge in redemption requests during the market downturn, it actually triggered the collapse of his scheme because Madoff couldn't meet the demand. That liquidity crisis is what ultimately forced him to come clean to his family on December 10th, 2008. As he only had $173 million in liquid funds, he decided in a panic that he would give all his money to his employees as a bonus check. So Bernie Madoff gathered his two sons, Mark and Andrew, as well as his wife, and made a stunning confession that would shatter their lives and shake the world of finance. Just days earlier, he had told his family that he intended to distribute these bonuses to the employees of his firm, which did not make sense to his sons during this time of crisis. So they raised their eyebrows and began to question Bernie Madoff a little bit further. Given the deteriorating market conditions and growing financial pressure, again, it didn't really make sense. His sons, both senior executives in a legitimate trading division of the company, just didn't understand. It had to be more of an explanation, they figured. So sensing something was wrong, they pressed their father for answers. Under the increasing pressure from his sons, Madoff broke down and admitted the unthinkable. His investment advisory business was a giant Ponzi scheme. He told them it was all one big lie and confessed that there were no actual trading taking place. All these years, the returns had been fabricated, using the money from new investors to pay existing ones. Mark and Andrew were stunned. They also found out that it also paid for their lavish lifestyle. Until that moment, they had no idea that their father was operating a multi-billion-dollar fraud. His wife even asked, "What's the Ponzi scheme?" Horrified by the revelation and determined not to be complicit, they immediately sought legal counsel from one of their father-in-laws, who was a lawyer. Their lawyer advised them that they had a legal obligation to report the crime. That same evening on December 11, 2008, Mark and Andrew Madoff contacted the FBI. Within 24 hours of his confession, Bernie Madoff was arrested at his Manhattan apartment and charged with securities fraud. When agents arrived, he reportedly told them, "I knew this day would come." His arrest marked the beginning of the largest Ponzi scheme unraveling, one that ultimately defrauded investors of over $65 billion. The decision by his sons to turn him in fractured the Madoff family and cast a long shadow over their lives, with both sons maintaining until both of their deaths that they were unaware that the fraud occurred until that particular day. So in March 2009, Bernie Madoff pled guilty to 11 federal felonies, including securities fraud, wire fraud, mail fraud, money laundering, perjury, and theft from an employee benefit plan. He admitted in court that his investment advisory business was just one big lie and took full responsibility for operating the largest Ponzi scheme in history, which defrauded thousands of investors out of that money. Madoff waived his right to a trial, choosing instead to plead guilty in a dramatic courtroom appearance where he expressed true remorse but offered little explanation for how the scheme had lasted for so long undetected. So following his plea on June 29, 2009, Madoff was sentenced to 150 years in federal prison, which was the maximum possible sentence under the federal sentencing guidelines. This unusual lengthy sentence was symbolic. It was meant to reflect the massive scale and devastating impact of his decades long fraud. The judge, Denny Chin, called Madoff's crimes extraordinarily evil and noted the need for retribution and deterrence. The courtroom was packed with victims, with cameras. A lot of the victims gave emotional statements about the financial and emotional ruin that they had suffered. The sentence truly ensured that Madoff would spend the rest of his life behind bars, where he ultimately died in prison in April of 2021 at the age of 82. So, Bernie Madoff's victims were individual investors. Some were celebrities like Kevin Bacon and Kyra Sedgwick, Larry King, John Malkovich, Zaza Gabor. Darling. Some of America's wealthiest families, especially in Palm Beach, New York, and Los Angeles, they lost millions. The owners of the New York Mets, I believe. And some middle class retirees and seniors, smaller investors, they were also hit by this fraud. Many universities, Yeshiva University, New York University, Tufts University, banks and financial firms, Banco Santander, HSBC, Royal Bank of Scotland, JP Morgan, hedge fund and feeder funds, Tremont Group, Fairfield, Greenwich Group, Ascot Partners. Also charities. Charities. He hit charities. Elie Wiesel Foundation for Humanity, Pick Our Foundation, Hadassah, JEHT Foundation. Victims were really not limited to the U.S. as his scheme affected people and institutions abroad, especially in Europe, Latin America, Asia, and the Middle East. So Bernie claimed full responsibility for his actions. However, he did have some notable key players that were arrested as well as either pled guilty. One of those people, again, I mentioned before, was Frank DePascali, a longtime CFO. He pled guilty to multiple crimes, including conspiracy, securities fraud. Daniel Bonaventure, former operational director, and he was convicted on 21 counts and sentenced to 10 years in prison. His brother, Peter Madoff, because some of those funds were funneled through to the legitimate business, and as he was the compliance officer, he pled guilty in 2012 and received a 10-year prison sentence. Some of the employees on the 17th floor, Joanne Krupe, Annette Bongiorno, Jerome O'Hara, and George Perez, they were really vitally responsible for coming up with those false statements. And they were computer programmers. They wrote the software used to fabricate the trades and documents, and they also received 2.5-year prison terms. Enrica Contessa Pitts, she was a controller who pretty much swarmed off the SEC, and her signature appeared on key checks, so she pled guilty in her part in forging documents. David G. Freeling, he was his internal accountant and auditor whose rubber stamp filings were signed off by him, and he pled guilty on audit-related charges. Unfortunately, there were some people who committed suicide. His son, Mark Madoff, he did not know about the fraud. Thierry de Villehouchet, he was a French financier and co-founder of Access International. He lost over $1 billion in clients' funds and personal money invested in Madoff's Ponzi scheme. William Foxton, who was a British war veteran and investor, he lost his entire life savings. Also, Charles Murphy, who was a partner at Fairfield Greenwich, he jumped out the window. It was really unfortunate. So some of these organizations got fined and sued as a result of Bernie Madoff's Ponzi scheme. So over the course of Bernie Madoff's decade-long Ponzi scheme, several major financial institutions and feeder funds played critical roles, either knowingly or unknowingly, and also further enabling the fraud, often by channeling investors' money into Madoff's firms or serving as custodians for the funds that did. J.P. Morgan Chase, Madoff's primary bank for over 20 years, was at the heart of the financial infrastructure he used to manage billions in clients' funds. Although the bank denied wrongdoing, it ultimately paid $2.25 billion dollars in settlements to the U.S. Department of Justice, class action plaintiffs, and the court appointed trustee. Other major banks such as UBS and HSBC were also pulled into litigation due to their roles in supporting feeder funds. UBS was sued for $2 billion dollars by the Madoff trustee. HSBC also, I believe, for $687 million, and then settled with investors for $250 million. A number of investing firms and individuals were also central to funneling billions to Madoff. Fairfield Greenwich Group, the larger feeder fund, directed nearly $7 billion to Madoff and faced lawsuits from both investors and trustees. They ultimately paid off $300 million in combined settlements. Banco Santander's Optimal Investment Services Fund lost over $2 billion. It was also sued for misrepresentation. Smaller but significant entities like Comed Securities, they were sued for $1 billion and settled with the trustee for $277 million after the death of Stanley Chase, which was like their longtime associate of Madoff. So feeder funds based offshore were also sued by the trustee and collectively settled for hundreds of millions of dollars. Now, let's go back to Jeffrey Pinkauer. He was never criminally charged before his death in 2009. However, the court appointed trustee in the Madoff case, Irving Picard, pursued Pinkauer's estate in civil court. The estate eventually agreed to pay $7.2 billion in 2010, which is the largest single recovery from Madoff's victims, without admitting any wrongdoing. This massive settlement underscored just how central and unusually profitable Pinkauer's relationship with Madoff had been, and it also highlighted how the Ponzi scheme extended beyond simple fraud into tax areas or areas like tax manipulation and tailored financial engineering for high-valued insiders. So the aftermath of Bernie Madoff's Ponzi scheme was one of the most far-reaching in financial history. And again, to highlight over $65 billion in paper losses, although Bernie Madoff at the time said it was more close to $17 billion. It truly did affect thousands of investors, including individuals, pension funds, seniors, financial institutions worldwide. This scandal shadowed public trust in regulatory agencies, especially the Securities and Exchange Commission, which had received multiple credible warnings about Madoff for years, but failed to act. In response to the crisis, the government appointed Irving Picard as, again, the court-appointed trustee to recover assets for victims, and through these lawsuits and settlement, they were able to get money back from feeder funds, banks, and other entities. All right. So what was interesting was that with Irving Picard, he had to identify and reclaim the funds that were wrongfully paid out by Madoff's firm and distribute those recovered assets to the victim. He pursued clawback lawsuits against individuals where initially they weren't found to be liable, but he ended up sensing that they were liable. So he figured since they profited from or enabled the fraud, whether knowingly or not, they should be responsible. So he had recovered over about $14 billion, and that really made it a really successful recovery effort in the Ponzi scheme history. His work has been widely credited with helping thousands of victims recoup significant portions of their losses. He also, at some point, did pursue legal action against Madoff's wife, Ruth Madoff, seeking over $44 million in assets he claimed that were derived from fraudulent proceeds. Now, although Ruth Madoff was never criminally charged, eh, she maintained that she really had no knowledge of the fraud. Now, Picard argued that she had benefited through luxury homes, spending and transferring funds from the fictitious profits into her bank account. So in 2011, she reached a settlement with Picard agreeing to forfeit $80 million in assets and retain just only $2.5 million, while also waiving any future claims to her husband's estate or related legal recoveries. The settlement didn't require her to admit wrongdoing, but it did ensure that much of her wealth would be returned to compensate the victims. So, in hindsight 2020, Madoff's collapse prompted widespread regulatory reforms aimed at closing the gaps that allowed for his fraud to persist for decades. The Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 was a key legislative response. It expanded the SEC's oversight authority, increased whistleblower protections, and mandated stricter reporting and transparency for investment advisors. Also, the SEC overhauled their internal structure, making sure to add specialized units like the Office of Market Intelligence, and also implemented more rigorous training for examiners. Independent custodians and third-party verification for fund assets became more common, and they decided to further do more due diligence in the future and have higher expectations for investors and institutions abroad. Beyond this regulation, the Madoff scandal led to a cultural shift in the investment world. Investors became more skeptical of too good to be true returns and more demanding of transparency, auditing, and risk disclosures. Fund managers were forced to adopt a stronger compliance protocol, and many investors now see independent custodianship of assets, a safeguard that Madoff notably lacked. So, no system can really guarantee zero fraud, but the Madoff case served as a global wake-up call, driving a lasting emphasis on accountability, transparency, and the importance of a strong regulatory enforcement. So, as a future professional, I learned that his fraud was enabled by regulatory failures, blind investor trust, and a lack of due diligence. This case really shows how unchecked his power and deception had and can have for anybody who's considering doing fraud, and can truly have devastating consequences for thousands of victims. It truly did underscore the importance of whistleblowers and the need for strong internal controls and independent oversight. And most importantly, it reminds future professionals of the need to uphold their own integrity no matter what's going on around them, even when surrounded by unethical behavior. Thank you so much. Have a good night.